Hey, everybody. All right. Welcome to our first post-FTX webinar. Well, it's not the first. I think we did one other one, but this is the we did with the Wintermute folks, which was super fun. But this is the first one that's intentionally post-FTX. That one would just happen to be scheduled the day after the FTX collapse. This is our first intentional foray into this. We're gonna give everyone a couple minutes to join. So it's exactly 1 o'clock right now. We'll get going about 1:02 Pacific time. Jim, how you doing, buddy?
I'm doing well. Excited to be here. Excited to talk some solutions.
How's it in Florida? Is it hot? You guys, is it still hot down there?
It's honestly not great weather today.
Oh, really?
A little rainy, a little cool. Yeah.
San Francisco, it's cold, but it's beautiful. It's been super crisp and nice, but it's 50 to 60 degrees. But it's been just like absolute crystal clear skies and everything. It's been super nice.
Well, I'll be there next week, so keep it up for us.
I'm excited. No, we're gonna grab dinner or something. We Jim, did you have any assets in FTX?
I did not, thankfully.
Yeah. I just never, it wasn't like anything personal. I just never quite got around to it. Like I don't know why I didn't. It's just they were like kind of they were a late entrant. And so I already had my Coinbase and my Kraken accounts. And so then FTX came along, and I was telling someone else, it's like part of actually why I never got into it was that they did a lot of marketing shenanigans with their token. They did a lot of shenanigans with their token in general, but they did a lot of marketing shenanigans with their token. And like, I didn't really have the energy to figure it out. Like, it's kind of that difference between when you play video games as a 22-year-old versus a 38-year-old. Like, there's only so much time I have to like figure out all the intricacies of something. And like, they really use like their tokens for a lot of gamification and things like that. Then I'm like, okay, I'll figure this out at some point. Like right now, I'm perfectly happy with Coinbase Pro to buy and sell stocks, and I'll just move on with it. So
yeah, I can't pretend that I was smart enough to see what was going to happen and not intentionally use FTX. So in the same boat with you.
And the other thing, they also they were so geared towards the options and futures and perps and derivatives that like I don't trust myself to do any of that kind of trading. I you just imagine the first time I go into futures, I'm just going to lose like $1 million. Like we're going to be that guy that like puts in $5,000 and ends up owing $1 million accidentally on the other side of it, because it's just way too complicated for me, for my brain here.
I'm with you. Fun. Save the degeneracy for the DeFi protocols, right?
That's right. I keep all my degen on DeFi protocols. That's where I like to focus my degenerate energies. Degeneracies. All right. Let's get rolling here. Got a great crew today. Thank you everybody for coming. Day before Thanksgiving break kind of starts, I think. So this should be really fun. We got Q&A open. So if you have any, as we're kind of going through this, please feel free to drop questions into the Q&A room here. We're going to be covering a lot. So this is a very, very action-packed webinar. This is a really exciting webinar because we're going to be announcing some big product updates here. So drop any questions you have in the Q&A. We'll get to them on the other side of it. The theme for today is obviously FTX and building back. I mean, it's one of those things that is the focus of this is not to. We've already done a number of things where we focused on what went wrong tactically day over day with FTX. But that's not really the focus of this. The focus of this is what went wrong strategically, and how do we as an industry rethink it, and we as Bitwave help with that rethinking of these problems. So that's what we are going to be talking about today. It should be a lot of fun. My name is Pat. This is nothing here is meant to be general product direction, commitment to deliver. It's our safe harbor statement. And this is also not financial advice or anything like that. If you have any questions, please ask your registered financial advisor, your attorneys, your tax advisors, your Big Four buddies, whoever you need to talk to that is not this presentation. My name is Pat. I'm the CEO of Bitwave. That's my new headshot. We were just joking about this because we had to get new headshots, so I got mine. I don't know. It's okay. I like my old one. I had a lot more hair. It was a lot skinnier. Jim, you want to introduce yourself?
I love it. I like the Bitwave shirt and the coat.
So Jim, that was the important part.
I lead our sales and partnerships team here at Bitwave. Excited to be here. Have a really cool audience rolling in, both from the crypto native side and traditional finance side. Fortunate enough to work with a lot of our clients and prospective clients from both sides of the house. So this will be a fun topic, and hopefully bring some of that market perspective to the table here.
Yep, exactly. So here's the agenda for today is we will be discussing what we're kind of calling CeFi's moment of truth, which is, all of this is in the lens of FTX, but for what it's worth, the last 6 months have been a relative it's been a tough time for CeFi in general. And a lot of that is directly related to what we're going to be talking about, which is processes, controls, people, all of that stuff that we know and love here. But really the FTX collapse was sort of the pinnacle of the last 6 months. I mean, it was kind of there was almost this inevitability looking back on it, which is so weird, but there was like these we were looking at that photo of the guy pushing the small domino that had the giant domino behind it, without really realizing that we were seeing him push that first domino, which is really interesting. So,
and Pat, I'll say we don't know that this is the last domino, right? For those of us on Twitter and keeping up, right? But regardless of the next domino or other potential dominoes, like the themes we're talking about today ring true regardless of where we go.
Yep. Then we'll get into some product announcements. We'll go through some control structures, and then leave time at the end for Q&A here. And we'll have lots of interspersed discussion here. So I'm gonna kick it over to Jim. Jim, take it away, buddy.
Yeah, and I'll just underscore, excited today. We're going to talk about 4 themes here, some of which will be probably like really obvious and top of mind, especially for our traditional finance folks on the call. But we are going to focus on solutions here for the majority of this call, as Pat mentioned, right? So that's what we like to think about at Bitwave. How do we solve hard problems? And that's what we'll get into. Number one here that we're starting with, probably the most foundational, which is commingling of assets. That can mean a lot of different things. So Pat, I'm going to have you talk about that. But what we pulled here is a tweet from SBF. This was on September 28th. Heads up, rotating a few FTX wallets, et cetera, no big deal, nothing to see here. Now, part of the aspect of blockchain is we can see what SBF was talking about on November 28th. So pull a screenshot from Etherscan. You can see here 173 million FTT tokens. That's the FTX token going from FTX to Alameda. So, some skepticism about that relationship going years past. Now we see this on-chain activity, some of it explained. Pat, when we talk about commingling of assets, we've got user assets, we have corporate treasury assets, we have FTX assets versus Alameda assets, maybe Bahamas mansion assets. When we talk about commingling of assets, what do you see here?
Well, by the way, before we get too deep into that, I will point out there was this point in time where we all got really excited when we saw things like this. And I say that because looking at this from the abstract, like an alien who didn't know anything about SBF looking at this would see that we moved $500 million or $200 million worth of assets for 73 cents worth of transaction fees. So there's this aspect that even today I still am always amazed by the way the blockchain works and the things that can be enabled by it. I mean, this idea of moving that much money for that little fee with this much speed is incredible. The number one thing that they did wrong, well, I shouldn't say the number one thing, but one of the worst things that FTX did as part of their thing was obscene commingling of assets. And I don't just mean bad commingling, I mean obscene commingling. So we often will see folks that might have a omnibus wallet for a couple of different uses. That this was not the case because FTX had not just omnibus wallets, but they were actively sharing. If you haven't seen the screenshot of FTX's corporate structure, 130 plus entities spread around the world. And they were actively sharing funds between between the different entities with very little control. So there was a point at which they did a transfer from FTX to Alameda. Ostensibly, this was to prop up Alameda after Luna. We still haven't gotten all the details on this, but the rumor on the street is that Alameda was way overexposed during the Luna crash, and so they needed to borrow some money to be able to handle that. So FTX just sent over a bunch of FTT tokens, and with really no controls, they treated these as interchangeable. I think one of the worst things that we're all looking back in retrospect, if you sent money to FTX through a wire transfer, you were actually sending money to Alameda. Now, in our brains, we're all like, oh, that's no big deal. Like FTX, Alameda, same thing. But in the real world of what we actually all do here, it's a very, very big deal that you are ACHing money to Alameda to deposit into FTX International or US. So they were actually actively holding their USD in Alameda without even transferring it over to FTX. They were just holding it out there. So there was both USD commingling of funds, there was token-based commingling of funds, there was customer and treasury commingling of funds. They had very poorly labeled internal accounts, which was what was a customer asset, what were the liabilities, what was their leverage position. But this comes, we see this more than I would like to, which is that crypto companies have not adopted a lot of the FBO practices that traditional finance companies have. And that's something that we really just need to learn. Like that is a incredibly important part of our growing through all of this.
Yeah, great color. We're going to get into that in more detail. All right, so number 2, absence of controls. Pull the quote here from now the CEO of FTX, John Ray. Never in my career have I seen such a complete failure of corporate controls. And he goes on. For anybody that doesn't have the context, John Ray, this is not his first rodeo. This is not his first trip around the block. He was involved in taking over Enron after that scandal. He has seen some stuff. And even this guy, John, is saying this is a really bad look. So Pat, we talk about controls all the time with all of our clients and prospective clients in a lot of different capacities. It goes up a notch when you're custodying assets on behalf of somebody else, whether that's an individual user or an institution. Like, what are some of the most common control questions that you see day to day?
Yeah, I mean, the first common question we get is just how necessary this is. And it's one of those things that, like, you think about crypto companies a lot. Most crypto companies, every crypto company in the world is less than 11 years old. Most crypto companies in the world are less than 24 months old. And so you go into these companies that are, young companies, both in the, average age of the employees as well as the age of the incorporation. And you tell them you need these complex control structures that someone like JP Morgan has literally had 70 years to put into place. And it's a hard pill to swallow, because controls are designed to slow you down. And this is the fastest moving industry we've ever seen. I mean, DeFi went from 0 to $100 billion in 18 months. We've never seen anything like that before. So this idea of adding controls to slow yourself down necessarily is incredibly, it's a bit heartburn inducing for a lot of people that we talk to. But it's something that we always recommend, that we talk about a lot internally. We talk about a lot with our clients, and it's always a part of our implementations. This isn't just, it's not just installing Bitwave, hooking it up to NetSuite, and you're done. It's, you have an entire set of things that you need to be thinking about holistically around this world, that go from how you monitor, how you pick up new wallets in your organization, how you monitor movements of funds, all of that kind of stuff. And it's one of those moments. This is why we're calling this a moment of truth, is that it's one of those moments where we as an industry really do need to be getting serious about controls. Because even if we are good about, I'd say that one of the things that we see a lot is people will be good about OPSEC controls, multi-sig wallets and things like that, without being good about financial controls and segregation of duty controls and, onboarding KYC controls. So that's the other thing to remember here, is that controls are not just, do we have 2 signers on this wallet? It goes so far beyond that. It is important to sort of keep that all in mind here.
Yeah, and Pat, we see some of those, even those fundamentals that you just mentioned, right? Of folks that, single access to a wallet with tens of millions of dollars, and what happens if that person gets hit by a bus, all the way to the more sophisticated controls, but absolutely needed here. And I'll give a shout out to Tom on our team. We were talking the other day, and he quipped something about, let's innovate. These companies need to be innovating on chain with new products, not innovating in controls, right? Like you said, there are companies that have been doing this for many years, for decades. There's best practices that are established in terms of custodying assets. Now there's wrinkles to how we do this with digital assets we're going to get more into. But absolutely, this isn't the place that we're necessarily looking to innovate.
Yeah, I haven't heard Tom say that. That's a great quip, because it's so true. Like, of all the places we should be innovating, this is not necessarily the one where we should be innovating.
So number 3, homegrown accounting software. So I guess, we create software here at Bitwave, so you take what we say with a grain of salt, but to some extent, this is the time when you're custodying millions and billions of dollars of assets on behalf of somebody else is not the time to put some homegrown software together with duct tape and call it a day and hope that it works. So Pat, we have conversations like around this, around how Bitwave works with existing software. But like, what's the most common item you see with custodians today as they're thinking about their software stack internally, either what exists or what they're looking for?
Yeah, this one is near and dear to our hearts, and obviously take it with a grain of salt because we have a vested interest in this. Like, I mean, I think for all the pain and misery of the last few weeks, like there were a few smiles at Bitwave when we read this particular tweet here, because it's something. I mean, it's honestly, I even kind of joke about. We were trying to sell FTX for a very long time, and they would never return our phone calls, and it makes sense now that we read this. I'm like, oh yeah, that makes a lot of sense. Like, why use a product like Bitwave when you could build your own that has your own backdoors in it? So that's pretty nice. You know, what we don't normally see the level of sophistication that they had. Like, you don't see people normally building full ERP systems. What you'll normally see is a combination of spreadsheets plus internal tracking, your internal tracking software. So if you think about how most exchanges out there work, they're going to build a piece of code that watches the blockchain for a transaction. So they give you an address to say, okay, we're your custodian. Here's your address. When we see something hit this address, we're gonna mark a database that says, okay, you got one Bitcoin because we just saw it happen on the blockchain. That is what most people have kind of built to this point. And if you step back and think about that from the perspective that we all look at the world, which is accounting, tax, and controls, that really is a single-sided ledger. It's debit, Bob's digital assets. It is not credit liabilities. It is not anything else. Like a homegrown system tends to be a single-sided ledger. And so when I actually imagine that their ERP probably was not particularly sophisticated, I actually imagine that it was mostly just the management software for FTX as a platform. So monitoring how many assets they're getting on a daily basis, with maybe a little bit of accounting stuff, kind of a sousance of accounting stuff sort of mingled in just to make it fun. But that's not, like, these things are incredibly complicated. Like, you don't want to be homegrowing this, especially for digital assets, because there's so many wrinkles. And we'll talk about that a lot more as we get into this. There's so many wrinkles of digital assets that this is not what you want to be homegrown, whether that be on spreadsheets or in software or anything beyond that through it. So.
Yeah, absolutely. And I would argue, homegrown accounting software is probably generous in this situation, to your point, right? Like, based on what we've seen in some of these reports and based on what we typically see in the market, especially when a lot of these companies in a bull market have been, growing 10x, 100x, taking the time to put in the right controls, the right technology. That's what we're getting into here, but incredibly important.
And Angel asked a great question, which is, what are some of the controls kind of like Silvergate Bank could improve on to provide more assurance to the public using centralized exchanges? We're going to be getting into that a lot more. That's the whole second half of the presentation. Will be all about how do we actually want to build a framework for doing this intelligibly. It's a great question here. So we'll be getting into that much deeper here. So.
All right, so last piece here, risk management. There's a lot we could go into. This quote from Fortune kind of ties a couple of the things that we've gone into together. But one report had FTX at nearly $16 billion of unhedged market risk exposure, essentially looking at on-demand liabilities that were financing illiquid assets, and those things just don't go well together. Pat, we've talked a little bit offline about the FTT token and some of what they're doing with Serum. And even, as evidence in some of the screenshots of the spreadsheets is like evidence on their balance sheet, kind of what was going wrong there. But like, what stood out to you from a risk management standpoint that others can learn from?
Yeah, the two things that really stood out to me. One was and this is sort of like quoting SBF over the course of the few days. One was he didn't know his leverage position. Leverage is what brought down 2008. Like, we literally had a worldwide recession caused by over leverage. I think someone told me it was that Lehman was at 34x leverage when they collapsed. Although, don't quote me on that. I could be my memory could be off on it. But leverage is what ultimately will bring you down in these situations. It's ultimately what causes the contagion to be really bad, right? So if you are borrowing leverage, you are creating more substantial systemic risks. So first and foremost, that SBF did not, like, he said this in that amazing. I don't know how you describe an on the record Twitter DM thread with a reporter where you spill your guts. But in that on the record Twitter DM thread, he basically said that he didn't realize how much leverage they had, and that's inexcusable to me. This is where there's a lot for crypto companies to learn from TradFi, because every TradFi company has a very large risk management, well, maybe not very large, but they have a risk management desk that does nothing but think about, hey, if this knob turns this way and we're sitting here, what happens? Do we just lose all of our customers' money? And that think deeply about leverage and how to model this kind of stuff out. And honestly, it's kind of the thing that's like, there's a few things that are most disappointing about FTX. It's one of the ones that is the most disappointing about them is that these were quants. Like, these were not crypto native people. If there's one thing that we've learned very, very severely over the past couple of weeks is that Caroline, Sam, like these guys were not hardcore crypto folks. These were Jane Street quants and TradFi folks that came into the space. If anything, they should have been incredibly heads up about how you think about leverage in your risk management practices, because they would have lived through it. Like, he would have had to file risk management reports at the end of his trading day when he was trading for Jane. So it's one of those things that, like, it is a very, the exposure and leverage risk is a incredibly important part of this to think about. But then the other part that was just shocking about this was the FTT and Serum tokens. On FTT, they said they had whatever, $5 billion. Serum, I think they had $2.3 billion on their balance sheet. And in the Serum instance, which I know pretty well because I was reading through a lot of this, Serum, they had something like 2.3 billion tokens because it was their token essentially that they had launched. But the actual circulating market cap, which is a term that you might not be familiar with, but in the crypto world, it is the market cap of tokens that are actively moving. You can think of it as like a market depth. The problem is you can't really do market depth very easily in crypto, because there's so many different markets where you could. It's not like there's one market for a particular stock and you just look at the order book. There's so many different markets for crypto that it's a little hard to do a real depth analysis. But you certainly can do you can actually look at the age of the tokens and what's moved and what's happened. And so for them, they had this wallet of Serum tokens that had never moved. It was part of the original mint. So that was like 2.3 billion tokens that basically no one included as part of circulating tokens. So they had a circulating market cap, which is the price of the token times the circulating assets, of something like $93 million. So you have, on my balance sheet, I'm saying I have $2.3 billion of assets. The markets support a market of $90 million. I can't sell my $2.3 billion. Like, that's not a real thing. Most audit shops, and this is where things get kind of interesting, is that like most audit shops will come in and ding you for that. Like, they will do some sort of defensible valuation for your tokens that will include looking at what you could sell through. And they would have actually dinged pretty hard for this idea of $2.3 billion in a $93 million thin market. So this is something we're going to be talking a lot about, because it's an incredibly important part of this. It's one of the things that really annoys me the most about all this, to be honest. Like, more so than almost any other part of this, I never loved kind of meme coins. I never loved tokens like this. Like, the thing that gets me excited about for crypto is this, right? 78 cents to send $200 million around the world. It's not the meme coin token that like had these like very, very questionable economics behind it. Because the idea behind FTT is that they would buy and burn FTT. That's essentially algorithmic stable coin. You don't want that in your life. So we are looking at how we rethink a lot of this sort of pricing of these type of long tail tokens, for whether it be for impairment purposes or other purposes, how we sort of conceptualize this long term.
And Pat, I'll say a couple of things there. I mean, the risk tolerance that you mentioned, and maybe expecting a little bit more out of them, some of the stuff that's come out since, the risk tolerance of the users didn't necessarily match up with the risk tolerance of SBF and Caroline. Some of the prior, CeFi breakdowns were in those user agreements, a hedge fund with a UX, nice UX cloak on it saying, we're going to do whatever we want with your tokens. Obviously a different situation with FTX, but regardless, it all starts with visibility. And I think, Tina, your question around, address the importance of developing APIs for direct data interface rather than relying on uploads and spreadsheets and things like that. I mean, I think, Pat, maybe you could speak to that, but I'll just say, with my background in fintech on the corporate treasury side, all of these things when it comes to risk starts with data and visibility. Like, the first thing a corporate treasurer does in the morning is what is my cash position? The same sorts of concepts apply here. But Pat, do you want to address Tina's question there?
Could have said it better myself. I mean, this is the automation of this is an incredibly important part of it. And in fact, what I will offer is that it's one of the things that makes it most difficult for institutions and for exchanges, because you actually, it is very hard to automate some of the stuff that we're going to be talking about today. So some of the things we're going to be announcing are tools to help you when you are not able to fully automate. So as an individual company, being able to plug in your wallet into Bitwave and pull down all the data and have that kind of come from an independent third-party source is incredibly valuable. The second that you actually are taking, where you actually have a wallet that's tied to a client's account, you suddenly are in this really tough situation where you have an internal book of records, what you might call an IBOR or an OBOR. You have Bitwave as a accounting book of records, and then you have the blockchain, and you end up in this triple-legged reconciliation problem where you're only able to automate one of those two legs to be off of full blockchain data. And so that's one of the things that we're seeing that's really, really complicated. And people don't really, it's the biggest departure from TradFi for the crypto world, is that TradFi, you will do some sort of reconciliation from an internal IBOR to like DTCC or something like that. But like, that's a very different type of reconciliation than what you need to do on the blockchain. So yeah, it's a really, really good point there. Jim, you want to handle this sort of last one here, and then we'll dive in.
Let's do it. Yeah. So, I mean, this is just capping off some of the process and controls and why this matters, and then the stack that this gets to. But you've seen some of the consequences in real life here with the players, but we're talking about inefficiency, fraud, inaccuracy, incompleteness. I mean, these things, when you talk about spreadsheets, it can be as simple as an accidental fat finger. It can be as complex as like complex fraud that somebody's purposely trying to hide. But regardless, a lot of these processes, without the technology, without the controls, I'd consider that not audit ready. That's for sure, as well as exposing you to just a lot of risk in general.
And it's one of the funny not funny things about this whole thing is this was fraud, but it wasn't complex, right? Like, if they had run through even a modicum of compliance activities on this would have been caught very, very early on. This would have been pretty easy. So we like to think about the world this way. Like, it's one of the things that probably annoys our clients the most. I don't know, maybe there might be some UI stuff also, that's on me. But when we come to our clients, like we make a really big deal about processes and controls. We make a really big deal about them mapping out their flow of funds and things like that. And I think a lot of people are like, I don't want to do that. Like, what a waste of time. Like, this is silly. It's one of those things that is, you are, by documenting any of this, you are beginning to set expectations for this whole waterfall of stuff here. So as you document your process, you establish what is a good action versus a bad action. So let's take FTX as an example here. Documenting process and controls would say, hey, we have a control where two people have to approve a movement of tokens between subsidiary companies. What that says, that's not just saying that two people have to do that. Yes, it is saying that. But what it's saying is, this is a potentially bad thing to do. Like, there are reasons you don't want to willy-nilly move assets between subsidiaries. So we want to put a control in where two people have to review that. So it's when you don't have controls around, you don't have documentation around those flows, you are essentially not establishing what is a good action or a good behavior versus a bad behavior. And you're never establishing what is a risky behavior versus a non-risky behavior. Moving assets between Alameda, which was a US-centered company, and FTX, which was a Bahamian-centered company, that itself created an enormous risk, which then meant that it was unclear where they were even going to be going into bankruptcy proceedings. And that even further then meant that when they went into bankruptcy proceedings, the Bahamas came in and started sweeping funds away from them because they were under Bahamian rules, not US rules. So there is, when you are doing things like moving funds between subsidiaries, there is risk, there is appropriateness and goodness and all that kind of stuff. That then trickles down this entire, it just keeps going and going from there, is when you never define what is good or what is bad, then you continue to have this variation in like Caroline does this and it's okay, Sam does this and it's bad. You have no way to compare apples to apples on these types of things. And then you end up with where we are today. Ori put this slide together and in typically understated Ori fashion said gaps in expected outcomes. I suppose that also could be $8 billion missing, but yes, that is $8 billion gap in expected outcomes off of this thing here.
And,
so this,
and Ori will be very happy to hear you talk about flow of funds, Pat, and that really is important for an enterprise implementation like this. And back to that quote where they're using emojis in Slack to approve meaningful payments. Like we love Slack at Bitwave. I know, Pat, you love the Guy Fieri emoji, but we don't use that in our payments approval process. And if you documented that,
I don't know, there were some good ideas in that bankruptcy filing.
if you documented that in a flow of funds, that's where it's going to get called out, right? And so you can't just solve for it by throwing technology on top of it or a homegrown account. You need to go through that process as well.
But for everyone who didn't get that, this was part of the bankruptcy proceedings came out that the way that they would approve expense reports is the executive, you were saying, their expense report would send back a emoji. And it wasn't a consistent, it's funny that we even have to get to this level of detail, but it wasn't a consistent emoji where everyone used the Guy Fieri emoji to indicate a successful expense report. It was the different executives were using different emojis to represent acceptance of an expense report. It's like there's something almost silly about this whole thing, but I don't know what to say. All right. Stephen asked a great question about proof of reserves. We'll be talking about this a lot. This is a big theme of the of what's coming out here. So under the auspice of kind of everything we've talked about this point, we are announcing kind of a new product today, which is called Bitwave Institutional. You might know Bitwave. We have our Bitwave kind of standard package that maybe many of you use, many folks around you use. We have our enterprise package, which our larger Fortune 500 companies use. Bitwave Institutional is a set of modules that are put together specifically to deal with customers that are custodying assets for other people. There are other things that you can use it for, don't get me wrong, but the main focus here is that anyone that is taking on a institutional posture, which doesn't just mean exchanges and custodians. The thing that's crazy about crypto is we see a lot of our clients ending up in an institutional posture, a custodial posture, whether they actually intended to go that way or not. And so the idea here is to have a product that can kind of reach from your small NFT shop that has ended up holding on to NFTs for their clients that paid with credit cards, up through the biggest Fortune 50 banks in the entire world, and have a repeatable set of processes, controls, people recommendations, and technology to basically support that entire endeavor. So this is Bitwave Institutional. We'll be talking about that for the next half hour here. The thing that I want to point out here most is that we are, I got to write a lot of op-eds the last couple of weeks, which is super fun because I actually really love writing. I don't get to write a lot of op-eds. And the goal of the op-eds, especially the one that I did for Cointelegraph, which was, let's get back to building here, is that there's all this great stuff about crypto that gets lost in the shuffle when all we're doing is talking about the price of Bitcoin. And we've been trying to sort of send this message of a call to arms for us as an industry to rethink the kind of 10x mentality and get back to what it is. I'm going to keep going back to this slide because this slide is not a 10x slide. This slide is about this screenshot is a marginal efficiency slide. Sending $100 million around for 73 cents with high assurances and visibility and all that kind of stuff. This is a marginal efficiency slide. So I've been talking a lot recently about marginal efficiencies, and that just continues here, which is that we as crypto actually have this really interesting opportunity to start to redefine what it means to offer a high assurance institutional product or an institution of high assurance to our clients. The reason I say that is that crypto folks have come into institutions like CeFi institutions with much more of a caveat emptor type perspective. So this is not, you go to TD Ameritrade, JP Morgan, Morgan Stanley, and I put $1,000 there and I buy some Microsoft stock. At no point do I ever wonder about the solvency of that institution at no point do I wonder about whether or not I'd be backstopped if these guys go out of business, because I've seen it enough times in my life that I know I'm okay. And so there's this aspect but with digital assets, that's not it. I mean, the rallying cry for digital assets is not your keys, not your coins. And so there is an onus that if I'm going to have a CeFi institution, if I'm going to be a institution, which, by the way, is incredibly important, right? Coinbase, FTX, Binance, these are the first mechanisms, the first way that many people get into crypto is through these exchanges, because people are used to this. They're used to the CeFi world where you're familiar with Coinbase. You saw their DVD bouncing commercial on the Super Bowl. You're now like, you want to get into this stuff. You go to the people, they ask for your social security number. Like, that's familiar. But there are things that are demonstrably different. So traditional institutions have a high regulatory environment. Digital native institutions tend not to have that same environment for no other reason than the regulators have kind of continuously not defined a lot of the regulation that we really need to. I think that will change here pretty quickly. But anyways, there's an assumption of solvency. And honestly, this is not meant to be a good versus bad slide, even though I use green on the left-hand side there. This is not meant to be good versus bad, because an assumption of solvency is actually not a good thing, right? Me assuming that Lehman Brothers was totally solvent when I put my $1 million in there, that was not a good thing, because assumption of solvency implies complete trustworthiness up and down the stack, which we've seen every 10 years for the last, since money was invented. We've seen that there is a reason to not trust institutions with your funds. So in fact, I actually like the right-hand side of this one better, which is that digital institutions do have an assumption of insolvency upon them. And it's up to the institution to sort of prove that they have it. Traditional finance there's an assumption of a government backstop. We can argue about this till we're blue in the face, but if JP Morgan were to fail tomorrow, it would be backstopped by the government. There's almost no two ways about it. Like if they took some sort of systemic risk that meant that they were about to go completely bankrupt, they would get backstopped, bailed out. I would not lose money as an individual investor. Crypto has no assumption of backstops, which again it's not a bad thing. Like, it's kind of a good thing, because all of this is pushing towards this idea of, can we change the idea from an assumption of trust in the institutions to a posture of the institutions to prove their trustworthiness up front? And by doing that, can we start to actually, is there even a world where we as the digital natives, or we as sort of the more digital asset native firms, can start pushing really interesting best practices back to the traditional finance firms? Like, wouldn't it be nice if I actually did have a proof of reserve from Bank of America that showed how much USDC they had on their books? There's some of that stuff today. You rely on regulators or some ways to look at it, but being able to look at the blockchain is a incredible level of transparency. So with digital native institutions, you have high transparency compared to the low transparency of traditional institutions. You have no idea. Like, no one really knew about the leverage exposure that Lehman had until they started to unwind it. Like Michael Burry, he knew, because he's a smart dude. But it was really hard. And of course, you have this last piece here, which is so important, which is the traditional institutions that have developed the processes over decades and decades and decades. And we on the crypto side have developed them over months and months and months, and we're trying to figure it out. So the whole point here is to say, look, this isn't a good versus bad. There are really good things to be taken from both sides of this. And is there actually a way that we can begin to think about institutional CeFi proof of solvency in a way that is that actually would even at some point be something to aspire for traditional finance folks? So that's the challenge that we sort of took upon ourselves at Bitwave as we began to think about the Bitwave institutional product. Is, can we build a product that will, and a product, a set of processes, all that kind of stuff that will actually kind of get into this. Jim, one of the things I was going to talk about here is a little bit the ethos of transparency. I mean, you're a hardcore crypto guy, and you also come from the fintech world. Like, it's a big difference, right?
Well, I was just going to laugh that the high transparency on the right is theoretical, or maybe we need a third box that's DeFi, yeah. Right? And like DeFi is converging with TradFi, with digital native institutions, and this is coming together to fulfill the promise, as you stated. But yeah, to your point on that screenshot, like, some of the transparency exists. but how do we get it out there and make it visible? And that gets into, we're focused on the accounting side of this, but that gets into the user facing aspect as well.
Yep, that's a very good point. So theoretically high transparency, and theoretically they have processes, but that also is not always the case as we've seen here. So this is the way we are conceptualizing Bitwave Institutional, which is that the goal here isn't to turn out a Merkle tree on the other side that has some form of proof of reserves or proof of liabilities. That is a component of it, but at the end of the day, that's actually not what's important here. The goal is that there has to be some way to prove a institution is in a solvent financial position, so that me as a user can say, I trust Coinbase, I trust Binance, I trust KuCoin, because between their processes, the way they get audited, the public data they share, everything that they've done has led me to a point where today I feel high confidence in this institution, and I feel confident giving them my money, and I feel confident recommending at 2 days from now on Thanksgiving, I'm going to recommend to my mom to buy some Bitcoin on Coinbase, because I'm not worried that it's going to go out of business in 2 days here. So this isn't just like, so Bitwave Institutional is not just a single bit of technology, although there's some really, really cool tech that we've built as part of this. It really is a set of processing controls, ways to think about your team that you're building, as well as technology that all together are going to build the insurance that will actually be able to present to you that you as an organization be able to present to your clients, that gets into proving that you are a trustworthy custodian. Here's the way that we're sort of looking at this on the left-hand side. There's sort of 4 quadrants that we think that you can be graded on within this. And it's part of you when we get into the actual institutional side, part of what we are working with with our partners. So we partner with, folks, auditors, the big 4, things like that. What we are sort of recommending is that you actually take this very methodical approach to these different quadrants and analyzing where you as institutions sit within them. So first of all, client asset and relationship management. This seems like a really silly one to put in here, but at the end of the day, it is incredibly important that you are thinking about your clients holistically. You are thinking about your clients' asset exposure holistically, and you are thinking about how you manage the relationship, whether that be 1099 reporting forms or things like that, or even your regulatory relationship, and even on through your KYC AML relationships. This is something that you should be thinking about holistically as an institution. You have an operation and regulatory risk management posture, which is that this gets into how you are dividing responsibilities between trading desks and the people that are doing the day-to-day work. It's far too frequent that we see amongst our customers that businesses that look and smell like a startup are in fact really involved in a lot of trading activities. It's kind of the nature of crypto, is that if you're in crypto, you kind of like trading the stuff, you kind of enjoy that part of it. And so it's one of those things that like no TradFi institution has their the dude that builds the exchange also the guy trading on it. Like that would be an incredible conflict of interest. There's so many different issues with it, you can't even get into it. It's not that weird in the crypto world. And it's even not that weird. We're like, hey, I get paid for XYZ service, but then I go and I'm like day trading. And when you're doing that, you're not thinking about risk systemically, you're not thinking about risk holistically, and you really need to start thinking about that. We'll talk briefly about asset tracking controls. This is probably the thing that we here all know the most about, right? So in terms of how do you keep your keys secure? How do you track that? How do you monitor it? It's stuff that we all spend more time thinking about than necessarily the risk management, the client management, even the stakeholder reporting. We tend to think about that last. And then of course, proof of reserves is on everyone's lips. We're proposing kind of a slightly different way of thinking about this, but it is getting into this, stakeholder reporting where your clients are your stakeholders, your auditors, your stakeholders, your boards, your stakeholders, and honestly, the overall institution around this is your stakeholders. And then Jim, talk a little bit about this. It's not just one thing. It's not just process. It's not just people, right? It's this whole stack of stuff that we have to sort of work on here.
Well, it's a whole stack, and I'll just underscore, and I know we've got 15 minutes, so I'll keep it brief, but I'll underscore that this isn't like we're saying, come talk to Bitwave and we solve every single one of these problems, right? Like these are the way that we're thinking about the problems. We also work with best-in-class partners. So shout out to our partners that help drive this process and controls and can work with you, as well as your internal stakeholders.
Yeah. This is going to be there's only so much that you're going to see in the next few slides. that is actually new Bitwave product announcement. That's actually what's really fun about this. When you look at this, you'll see the green items here are the new Bitwave product announcements that we're going to be talking about here. But everything else is actually stuff that you need to take on individually. We are going to be publishing white papers with guidance on this. We'll be working with our partners to actually publish working guides, guidebooks, things like that on how to go through this. So, a lot of the themes through all of this will be, ad hoc versus structured. That is the entire point of this. That is what failed FTX ultimately, was that they were running, all of their processes were more or less ad hoc. Very few of them were particularly structured, and that ended up creating so many different issues. So when it comes to client management, there's really obvious ones that you guys probably know a lot more about than even I do, which is in terms of KYC and how you do all that on your clients. But it's worth saying that you really do need to have a structured model for KYC and AML that is vetted by people who know this stuff well, people who understand the risk that you are taking on, people who understand with regulatory environments and all of that. You need to be very careful about homegrown sole sources of truth. So this gets into what I was talking about with FTX, is that I don't think they really had an ERP. I think they just had their exchange management software. They called that an ERP, but realistically speaking, that is a single source of truth. I'm gonna poke fun at someone I met the other day, which he was a super nice guy, so it's not meant to be mean. But I asked him, he asked me why we needed this. I'm like, oh, did you ever see Office Space? And he's like, he works in tech and he'd never seen Office Space. So I demanded he immediately go and drop off the call and go watch Office Space. But there are really good reasons beyond just what we're talking about here to not rely on your engineers. Engineers cause bugs. Engineers introduce defects that steal a penny per transaction. There's all these different things that can happen in your system that you really don't want to be in a situation where you are depending on your engineers for any significant amount of confidence. You want to have your homegrown system that is going to be managing the deposits and withdrawals, that sits alongside an ABOR, Bitwave, that sits alongside the blockchain, and you're doing a reconciliation between all of them. We're talking a lot about this triple leg reconciliation. That's one of the big feature announcements here. But it's a really important part is you can not only rely on your homegrown systems, you have to rely on something. And that includes, one of the things we're announcing today with part of Bitwave is that we are now going to have a notion of clients within the institutional product where you can actually have clients directly inside of Bitwave. We don't take PII, so it'd be based on ID numbers, that you can track deposits, withdrawals, and trading activity so that you can begin to create a full client asset view of your client assets that is side along with a custodial balance sheet set of liabilities you owe to your assets, to your clients. So every time you add a deposit to a particular client in Bitwave, we are making several different entries around that. First and foremost, this client now holds XYZ amount of digital assets. B, you owe this client XYZ amount of digital assets. And by the way, your wallet over here has that asset in here that we're going to be doing asset reconciliation against. So full tracking for clients is part of the institutional product. If you are interested in this, we'll have this later, but just reach out to info@bitwave.io, ping us on the website, anything you need to. We can do full demos and all that kind of stuff around it. The second piece of this is obviously commingling customer treasury assets. Don't do it. That gets into this idea of having a single corporate balance sheet. So for most of the institutions that we deal with, the way they should be operating would be to have a corporate balance sheet that is segmented from their FBO balance sheet. A lot of people that we deal with on a day-to-day basis don't actually know what FBO means. And that's kind of something that people should worry about a little bit. This is the idea of a for benefit of wallet, set of accounts, exchange accounts, and a full balance sheet that you are essentially tracking for the benefit of your clients, completely segmented from your treasury assets. The reason a lot of people don't do this is that it adds a lot more complexity. Because if you imagine that for benefit of, as people are trading and you're getting commissions, you are actually creating a receivable from your internal treasury against your FBO accounts. So there's this added amount of work that gets into tracking that receivable, clearing it out when it goes through. This is all part of Bitwave Institutional, is how you actually can be tracking token-based receivables against your accounts and getting into it. And then finally, we'll mention here is that we hear so much about proof of reserves, but proof of reserves is only half of the story. The more important half of the story, like I can prove that I have 1 Bitcoin, but if I owe 10 Bitcoin, that's the bigger issue. So we are announcing today, essentially based on the ability to track client liabilities, client assets and liabilities, we have the ability now, we are launching the ability to actually do a full polar accounting, which is something we just named. We'll see if that sticks. But this is the idea of a proof of liabilities and reserves. You can't just look at one side or the other. You have to be posting, like what Binance has been posting the last week is great, but like their reserves don't matter if they owe $1 trillion. So you have to be posting a combination of the liabilities and the reserves. And this is why auditing is not going away, because what we as a technology provider can do and what the blockchain can do is we really can just handle that proof of reserves component. We can help you publish the Merkle tree, but someone, an auditor, is still going to be in there looking at your asset, your client assets, and doing validation, doing double checks, making sure the deposits match $, making sure your ACH deposits match your cash positions. So all of these things are super important as part of your overall thing. And this is, part of the Bitwave Institutional is an actual client-facing proof of liabilities and reserve interface people can kind of use there. Jim, what do you anything to add on this slide?
Yeah, no, that's a lot to it back. I'll say briefly, like there's a lot of talk about, hey, why isn't everything DeFi? Why isn't everything on chain? Like, why do we do this? I think we're sitting in that middle of, like, you probably wouldn't find a company that talks more about new DeFi innovation than Bitwave, right? And what we're talking about in Slack and what we talk about, we go to happy hour, but we're sitting in this like practical middle of how do we take these on-chain activities, how do we take internal blotters? And then Pat, to your point, if we're taking internal data, that means we still need auditors and advisors and folks that are reviewing this as well. So it's not just a technology solution, to underscore that.
100%. We got a great question as part of this. The question was, what solution do you recommend for a seed stage multinational company that can't afford a robust ERP system, but is handling a large volume of client money for buying and selling BTC? So I will say to this, probably think deeply about it, about actually moving to a robust ERP on this. But I often joke that we have clients that have billions of dollars they're tracking through QuickBooks. And so if you're a company like this, you can very reasonably set up 2 or 3 instances of QuickBooks, an FBO instance, an instance for each of your multinational subsidiaries. And then maybe if you need to, some sort of roll-up instance that you actually do aggregate reporting into if you really, really want to from that perspective. But there's a very real world where you actually can do a lot of this in QuickBooks if you just manage, if you are intelligent about, if you don't have a knee-jerk reaction from your client to actually do separate QBO instances, there's no reason you can't do that. So Bitwave, we can connect to multiple QBO instances. You can have multiple Bitwave instances or one Bitwave instance. It's a great way to sort of handle it from that perspective. But I would tend to think deeply about moving to a bigger ERP system to be quite honest from there, because it's this stuff is, it's even one of these things where if this is like a client relationship where you as a service provider think about this, you might even want you to kind of start putting the onus on your clients more and more to kind of demand that they do that, because what we're seeing is there is blowback on the auditors in a lot of these situations where if you actually are the person auditing or doing the books of someone who can't prove who goes insolvent or ends up with one of these kind of mass liquidation events, you might look very badly because of that. So there's a very real world where you actually do, as a service provider in this industry, want to think a little bit more proactively about that kind of stuff, which is interesting. So operations, regulatory, risk management. First and foremost, this is kind of a joke, but it's definitely not a joke, is that like, don't do leverage. There's no reason, if you are not a sophisticated trading firm playing with your own money, you really should not be taking leverage positions. It's way too difficult. Like, most people in the space are not sophisticated enough to be doing it. The tooling is not sophisticated enough to handle it. Like I say, this is a maker of tools in the space. Of all the things that we've built, we have not, as part of institutional, built a sophisticated leverage tracking thing. We have all the data, so you can do this is part of our data warehouse, is you can go in and actually do a lot of this analysis yourself. But it is very, very difficult to do large scale leverage modeling for the multi factors that kind of pop into this. checks and balances. This is a no-brainer. It's part of controls. We don't talk about it a lot, but you really need to be doing it. So you need to have checks and balances between different teams. You need to have a trading desk that is checked by a risk desk. You need to have your internal controls team that's checked by an external auditor. Like, that's the only way this stuff works over time. So you need to think about the checks and balances that get into this. Well, we already have talked about this a lot, but the valuation models here. So, you should not be using simplistic valuation for large scale holdings of tokens that are long tail tokens. So if you as a business, we often talk about this, that you should not be relying on any single model for pricing. Part of what we're announcing today is some models to help around pricing at the institutional level for true value pricing. So as opposed to using a simple, trading price times units that you hold, you really should be looking at circulating market cap based pricing that is more or less defensible. We can give you all the data. We as Bitwave can't necessarily do this for you, because you have to figure out what is defensible for your auditors. But you shouldn't be doing what FTX is doing, which is basically multiplying, 100 times a billion in some of your trillionaires. That's the wrong way to do it. And then the final piece that we're talking about here, I threw in here, and if anyone wants the deeper dive, because we're running out of time here, there's more data here than we probably should have put in here. We see this a lot, which is venue shopping. I'm going to go ahead and put this in the don't do this column anymore, because at the end of the day, one of the things that will ultimately be the biggest pain in the neck for FTX was the fact that they were doing this really bizarre series of venue shopping exercises meant that when they did finally go belly up, it wasn't clear where they should declare bankruptcy. It wasn't clear whose court has jurisdiction. And to the extent that the Bahamian authorities started moving money away from FTX because they felt that they had jurisdiction over the bankruptcy. Regulatory shopping, it can have benefits for very, very small companies, but for institutions, you really don't want to do it. And honestly, it's the biggest concern for so many people about Binance is that they've spent so much time moving their headquarters around, shopping venues, that no one has any idea really what venue or regulatory body they even fall under. That's Binance International, compared to Binance US, which of course is taking a very different approach and has really substantially pegged themselves to a US jurisdiction here. The last piece that we'll mention here, which is one of the things we're announcing today, is a full reconciliation model for triple leg situations. So one of the things that you're seeing in a lot of these cases we've talked about a lot is this disparity between the blockchain, your accounting book of record, which for FTX was an home grade ERP, and then your trading book of record, or your IBOR, your investment book of record. The hard part, of course, is that it's very difficult to do a reconciliation, a 3-step reconciliation. So for us as Bitwave, we are often in the situation where an institution comes to us and says, hey, we want to start tracking our client deposits. We then have to ask them, well, do you want to track your client deposits off of the blockchain, or do you want to track your client deposits off of your internal system? There are both of these situations have their pros and cons. But whatever we choose as Bitwave, which is, okay, we want to track your client deposits off of your internal system, you then need to take on the responsibility to do a reconciliation from your internal system to the blockchain. So if you're interested in this capability, it's a very, very robust capability that you now can do these arbitrary point-to-point reconciliations inside of Bitwave for large data sets that enable you to take internal data compared to blockchain data, internal data compared to Bitwave data compared to blockchain data. Whatever you need to do to handle this kind of complex, multi-legged set of reconciliations, we can actually handle now with controls, auditability, and visibility from everyone up and down the stack. Jim?
Matt, I'll just add, because I know we're against the shot clock here. That's huge for the traditional institutions getting into this space, right? Because this is a newer concept, an important concept, and it takes blockchain data and then tying all that out. So really, really big one there.
And the cool part for Bitwave is that we have all this data. We are just now exposing it in a new way that you can use for reconciliation purposes, for really complex reconciliations, as well as there's actually some other cool things that are going to come out of this for our non-institutional clients. But things like being able to generate really powerful sets of receivables data based off of staking rewards, whatever it is, all of that is actually coming off of our data product that we're kind of built into the institutional side here. I'm going to spend the least amount of time on this because people are really quite used to this. The thing I'll mention about your asset tracking is in this world, you need to start having, probably the single most important part of this entire slide is the hire for OPSEC and hire for paranoia. We as an industry there are some of us that are incredibly paranoid, and there are many of us who are not as paranoid as we should be. You know, programmers, and I take blame for this myself sometimes, we don't always, when you write a smart contract, you don't always conceptualize that it's billions of dollars you're touching as part of these like 3 lines of code you just wrote. We need to get out of that habit. Like people who are hired to touch either the keys, the smart contracts, whatever it is, need to actively be working on they need to be the most paranoid people you've ever met in your entire life. The people you're hiring to run these processes need to be operational security type folks. People who worry about, you know, the $5 wrench attack, people who worry about people following them on their way home. It is a really important part of this that we actually have not given quite enough effort to. And so I always said, like, you know, ex-military folks, things like that are great for these types of things. People that are used to thinking about security in depth around an organization. The other piece that we get to talk here about a little bit is we're launching as part of this a treasury-driven proof of key validation. So you're always going to have a world where someone like Armanino, who's doing a great work on this, is going to go in and make sure that you have access to your keys. We like to think about that as an internal driven process. So you as your organization, you can't rely on auditors. Like auditors are fun. Auditors are great. Auditors they're out there doing this stuff. You should be doing your own proof of key work. So this is that you should be actually, for all the wallets you track in Bitwave, you should be insisting that the people who control those wallets are signing messages, proving they have access to it, are making trades, proving they have access to the exchanges, all that kind of stuff. So this is a big part launching on Bitwave Institutional is our treasury-driven proof of asset, proof of key instrumentation. If you're interested in this, please reach out to us. We can walk you through how it works and what it looks like. But it's a control structure to add additional layers of assurance that you have access to the keys, you know how much money you're in these wallets, and you as a treasurer are doing the controls that maybe an auditor will also be doing later. Jim, how important is this? It's super important.
Incredibly important. And I know we got a couple questions and we're like out of time. So Pat, anything we want to get to, and then we'll make sure to follow up individually on some of these questions we didn't have time for.
Yeah, we're sorry we should have done an hour-and-a-half webinar today. There's just so much great content here. I'm going to hit a couple of these, which was someone asked, what are proof of reserves and can they be disclosed without compromising offset and tipping future trading activity? This is a really interesting question. And I think that you can start with saying, you know, the beauty of kind of what we're proposing here, what we're doing as part of Bitwave Institutional is not necessarily a OPSEC dependent one, because the first step to proof of reserves is proving your own proof of reserves to yourself, to a person in your organization who has the role to do treasury management, proving that you actually have access to all the wallets and keys and everything you need from there. You can then turn around and create different models for how you expose it out. One thing I'll mention here is that the question particularly says trading activity. And I think that this is a really interesting discussion to have here, because I actually think that you as an organization should be very, very careful about the assets that you're holding versus the assets that you're holding and using for trading activity versus the client assets you're holding. So put it another way, the assets that you are holding for clients with assurances on versus the assets that you are rehypothecating. So one of the issues that we see when we look at some of these proof of reserves reports is you will see a report that just lists out USD balances. We had this much liabilities. We had $1 billion in USD liabilities. We had $1 billion in USD assets. That is, if you were FTX and you looked at the world that way, you had $8 billion of USD liabilities, and then you had $8 billion of FTT. All things are not created equal here. So the way that we tend to think about this is that you really, we want to see the regulation that I actually do want to see in this space, which is like ridiculous for me to say, but let's all bear with me. I do want to see some amount of clarity given between custodians and exchanges that are rehypothecating and people like, hedge funds that are actually, doing this actual full rehypothecation versus partial rehypothecation. Exchanges should be under an auspice that they are not putting your money to work. Or they should have an earn product where you are intentionally opting in to your money being put to work. So the answer to your question directly is that if you have an earn product where you're putting your money to work, I think it's okay to create some amount of obfuscation around that because that is proprietary. But you should be creating a firewall between your earn product and essentially your exchange client held assets that actually does allow you to say, okay, we have one-to-one holdings over here. And then here we have one-to-one Bitcoin to Bitcoin, token to token holdings over here. And then here we have one-to-one USD to USD. Because we're doing the rehypothecation, we can't actually expose that entirely. So that's how I would start to think about this is you want to, like, you might be doing segregation between FBO accounts. Let's start now seeing like segregation between client assets and rehypothecated assets with real clear visibility to your clients about that. So at any moment they can go and double check their assets that they have not chosen to lend out on earn, and then keep it a little bit more obfuscated for the actual earn product. All right. Last but not least is the stakeholder reporting. We're just going to bang through this, but part of what we're announcing today is that if you are using Bitwave Institutional to track your clients, your client assets, and you're using Bitwave Institutional to track your liabilities, and you're using Bitwave Institutional to track your internal wallets, you will have the ability to do a one-click proof. We're calling it a polar attest, but a one-click proof of liabilities and reserves all together that you're able to pick up and expose to your clients. So this is one of the things that we are most excited about is, with Bitwave, you already have all this data in one place. Like this is already going to be in one place. You already are using it for tracking. We already have people doing this today. It's just, the idea behind this is to make a much more streamlined process from it. This is something that we'll be working on with all of our audit partners. This is not something that we are doing in a vacuum because at the end of the day, it's the audit partners that are going to be attesting to the proof of liabilities. So as you are getting into this, as you want to think about this holistically, we have a whole model for how you can actually do a full proof of liabilities reserve with audit attestation as part of it. And obviously you have all of your financials in Bitwave. That's a normal part of our world. And I love the last bullet point here, which is across institutional finance, because if you are rehypothecating or you have any model there, one single pane of glass for all of your holdings across the entire thing. Jim, anything I missed on this is super important?
Just not only that it's not built in a vacuum, just us, but with leading best-in-class large custodians today that are trying to solve these problems, right? So it's built in conjunction with the real-life problems and issues that we see.
Yep. So this is Bitwave Institutional, which is our framework for digital asset institutional processing controls. There's new technology. There are workbooks are going to get launched around this. There is partnerships with various auditors and external that is launched around this. But if you are interested in this today, this is something that we've been working on for a very long time. And it sort of seemed like the appropriate time to come out with it in large scale here. I think we're probably out of time for questions. This is how we are going to be thinking about this, going forward in terms of the actual architectural stack. But please, if you are interested, if this is something that is appealing to you, if you just want to ask follow-up questions about how we're thinking about some of these things like segregating earn versus client asset accounts, please reach out to us, bitwave.io, info@bitwave.io, or reach out to your salesperson, customer success person, whatever it is. Jim, anything to add, my friend?
No, this was great. Thanks for doing it, Pat. Excited to keep the conversations going.
Awesome. Well, thanks so much, everyone, for coming. This was really, really enjoyable. And we'll have I'm sure we'll have a few more things that come along this for everybody. So have a wonderful day, everybody.
Thanks, everybody. Happy Thanksgiving.